So, welcome. And today we are talking about federal employee benefits. We're going to hit the main part of it that is kind of our specialty more at the second half of it, which is the retirement benefits. So, you may know some of the things in here that are more the simple side of the benefits, but we do want to cover them because we want you to be able to, save the money and do well. Let me get this out of the way with what you have, not just get the investments right. Okay, because if you could save some money on your health insurance, get the right amount of life insurance. If you're older and want to look at the long-term care and cover that, do it efficiently. It's good to do. Okay, so let me see. I thought I had the screen share on, and it says it's off again. Okay, there we go. So getting started on this, we're going to cover, the life, the long-term care, the health insurance, the vision, the dental, the different savings plans that you can have with the health side of things. Then we're going to get into talking about FERS. If you're old enough to either know or have the CSRS, Civil Service Retirement, the TSP, and then a little bit into the military benefits as well too. And a lot of people these days, our predecessors, might have had one or two employees and they worked for the same person all their life. But I think the statistics now are, that our generation and younger, will have 6 to 10 different employers. So you're going to have some changeover more than likely, whether you were civilian young and then federal for a long time and then finish civilian or some combination thereof. Stringing that together well and understanding the differences and how to optimize things will help you a lot. Okay, so let's keep moving on. Oops, too far. And so the first thing we'll hit on is the FEGLI, the life insurance component. So making sure that you're covering the people that depend on you, and also you are able to get a little bit of extra coverage on your spouse or children as well too. So it's term insurance. And what term insurance means is it's like the lowest cost relatively, including whatever company's profit margin or administrative costs there may be, to just ensure the risk that you're going to die without any other kind of features. So you may have heard of like whole life insurance or other types of where cash builds up inside of it. There's variable universal life, there's universal life, there's index life insurance. But for most people, what they have through work and what they may buy on their own, especially when they're younger, is just term insurance. You pay this certain amount. If you don't die, you don't get anything. Okay, which is a good thing, right? But that's what it means. There's no cash value, right? You're gonna pay in, and if nothing happens to you, or if you insure any of your family, then you're not gonna get anything back. Okay, you can't borrow against it. The real benefit is just protecting against kind of that catastrophic loss financially for the people you care about. Okay, and so you can cover your spouse and unmarried dependents under 22. So there's no annual season, like open season on this. You can change most of the things anytime that you want to, enroll or increase your coverage. Sometimes when you're going over like what the basic is, you're going to need to do a physical exam because they don't want kind of like unnatural selection or adverse selection is what they call it, where people that are sicker buy a bunch more and people that aren't don't buy anything. And so then the cost for everyone would just go up, right? And so the basic, a lot of times you do it when you're supposed to, you're going to get a guaranteed amount, but it's going to be a smaller amount. And then if you want to buy a larger amount, then a lot of times they call it underwriting. They'll want to underwrite, okay? So keeping on going on. So their responsibilities, they have MetLife pretty much run the program. I think they've run it for like 70 years. It's amazing. Probably now it's so bureaucratically tied in, it would be hard, if not a little bit impossible, to super change that up. I don't know, Doge could probably do it. They pay the claims. They arrange for conversions afterwards if you wanted to convert it into like whole life or what. So they, all the changes or requests that you put in, they're going to handle that for you. If they have to do the medical underwriting, they're going to do that as well. Living benefits, what living benefits means, generally there's always a little bit of nuance. They change it over time, but the default is, if you get diagnosed with something terminal and you're going to die within the next 1 to 2 years, then you can apply for a portion of your death benefit early to help cover things, or take care of things before you pass away, instead of that money just coming afterwards. But you really have to be diagnosed with something that's for sure terminal. Okay. And then, so that's talking about MetLife's responsibility versus the actual agency's responsibility. And so, it's a little bit, you may not matter to you that much, but basically it's kind of like three things. It's the agency, it's MetLife, and it's OPM, and then they each have their own responsibilities in terms of what they do and passing on the money to Office of Personnel Management, so that everything is flowing and paying for itself, and they're taking care of the finances in the background. And then you issue conversion rights to the employee if you terminate or separate at the end of when you're totally off and not considered covered or paid, or 12 months, leave without pay. And then you can convert, like I said, change it into whole life or universal life, whatever those options are at that point. Those tend to be a good bit more expensive than what you were paying when it was term. So you really got to look at that and make sure it's worth it to you. If you're not sure, find an agent or find an advisor like us to help you evaluate that and make sure that it's a good deal for you, or they're not walking away from something that you can't get back later. Okay. And so this is what we were talking about, the basic and the optional coverage. And so you get your basic of the kind of standard issue, guaranteed lower amount, and then you can do the optional, additional that could need to be underwritten, or for spouse and kids. Okay. So I'm going to keep going through this because I got a lot of slides on these things, and I don't want to bore you to death, especially if you already know some of them. It's one of the few insurances out there to a certain degree that, they'll auto enroll you and put it in you. Even if you don't have any beneficiary, it's going to follow the flow of like kind of the standardization of like, spouse, then kids, then parents, then siblings. And so, if you don't want that standard, you've got to make an election, right? You need to go in there and change your beneficiaries if you want to have different percentages to different people, or you would rather it go to, your parents instead of your kids if something happens to you, or to a trust if your kids are young and you've done that estate planning, etc. And you could also have, where you got a second marriage, and you still want to give your first wife or kids some percent and your new spouse some percent, right? So, some things to think about that I don't think everyone necessarily does. Okay, so, make sure that you're looking to make sure that what you thought you elected, you're like, hey, if I elected this extra money should be coming out of my paycheck, right? So, like, I've seen people a lot of times in 401k elections, or, in disability or life insurance electing, say, oh, this is what I did. And then they find out maybe they didn't complete the process or sign something or push the submit button, and it really didn't go. And if they would have looked at their paycheck, it wasn't being withdrawn. So they would have known if they just look and see that they weren't paying for what they thought they were getting. And then just keep your beneficiaries up to date, because things change over your life in terms of what you want to have happen. Or like I said, marriage, divorce, someone dying, etc. They could change the law and change that order of precedence, which you thought was good, and now it's something different, and then just know who and how, to do it, because it, working federal side of things, it's a little bit different. And there's all kinds of different agencies and how their HRs work and systems and portals. And so it's going to be a little bit different for everyone. This is not as much for, I think, most people on here. This is more, we're talking to agency offices rather than individual participants, which I think is who is mainly on here. And so I wanted to show you this. So you can look at, what are the premium rates, when we look here. And again, it's pretty easy to look a lot of this stuff up. And so you can come here and say, all right, what's the overview? But let's look at the premiums for employees. And so you can see here, as you get older, it costs more. Okay, between 35 to 40, it's pretty standardized. And then as you go up, it starts to go up past that to 45. And then when you're younger than 45, you actually get more benefit. That's what it was showing over here. So for the same amount of money, a 40-year-old would get more of a benefit than a 52-year-old, because it's a weird way just how they priced it. Because the younger you are, the lower probability it is that you're going to die, right? Maybe not from accidents and stuff, but from the normal things that kill most people, like cancer and heart attack and stroke and different things like that. And so even though it's a little bit less expensive when you're younger, another interesting fact of it is between 35 to 45, that extra kind of bonus kind of phases out. If you're under 35, you basically get double. And then as you age up, then it phases out. Okay. And then you can kind of just see what the premiums are. You just got to multiply it out by how many thousands in benefits you're going to get or you want to purchase. And then if you're doing for spouse and children. Okay. And then, they're trying to make it easy for you, whether you want to calculate it getting paid bi-weekly or monthly. Okay. And then, that's for next. Yeah. So in that respect, it's not too tough. So if you were to get $100,000, just times it out, it's like $65 a month. Okay. And then you can see exactly, what things are. Okay. Let's see, I'm back here. All right. There is a calculator you can use on there. So if you don't want to do the math yourself, you can just pop it into there and figure it out, or have it figure it out for you. The next one we're going to talk about is long-term care insurance. This is not a benefit a lot of people use relatively as a percentage of employees, but it's actually a pretty good deal, okay, compared to if you were going to go buy a private policy. And when we're talking about long-term care, we're talking about if you need care in which you are not going to recuperate from, okay, then Medicare, your regular health insurance, it does not pay for that, okay? Only Medicaid will. And the only way to qualify to get Medicaid to pay for long-term care is to basically spend down almost everything you have, okay? So you got to get like poor before some government thing is going to pay for long-term care, okay? And a lot of people say, well, what does that matter? It's expensive. I mean, if we just look at the national average down here, you can kind of see just for home health care, you're looking at $162 a day. A nursing home, $276. In Ohio, it's $293. I mean, it's way more expensive in Illinois and New York and Alaska and what so. But if you look at that, just say take the average of $200 a day, and say you're home health care and you only need care for a little over half the year, it's still $40,000 a year, right? And then it's going to change. The reason why it goes up when you need more is it's more around the clock care, and you may need more skilled care versus non-skilled care. Okay. And so, if you try to stay home when you're really needing more medical, like skilled care, like a nurse instead of like a personal care assistant or associate, then, you could be pushing, $400 to $600 a day easy. Okay. So now you're talking about $100,000 a year to stay home. And if you need it more, you could push $150,000 to $200,000 a year. So this is a huge thing. That's why it actually becomes way more affordable for assisted living facilities and nursing home to pull those things together, economy of scale, once you need more care than you think. But if you have assets and you want to preserve your your freedom and your choice and not jerking your family into taking care of you, because it can be an extended time and it's hard work, then you either have to have the money saved up, which is a lot we're talking about, or buy some kind of insurance like this. And so that having a group benefit where you can buy it through that's been negotiated down and gives you kind of a guaranteed type issue, that's terrific, because a lot of the private ones, if you have anything wrong with you medically or mentally, cognitively, it's just denied. And so in that respect, you want to buy it earlier, lock it in, not necessarily too early, but like it says, it costs you $28,000 to $75,000 a year. And again, that's not even necessarily the high side if you were trying to stay at home all the time when you needed skilled care. Okay. So enrollment, so that's kind of, we were looking at some of these things here where we're on their website. If you go to the LTC Feds, then it'll give you more information like over here, but you can click over to that site that I was at, that this is actually run by John. Oh no, this is the Feds, and then you could be over here, and you can read about the long-term care, and it'll kick you to over here. And this is actually run by John Hancock. Okay, and so there, who has got the lowest bidder on this program, John Hancock. Genworth has traditionally done a good job long-term care, so that's not bad at all. And you can apply online with them. Premiums, you really got to kind of look it up. It's harder than it used to be. They have a couple different plans that you can choose. And so this is given an example, and I pulled it up over here. They used to have a calculator and be able to look it up a lot easier online. It's a lot harder now. Okay. And so here you can kind of see what are the different premiums for the different types of plans. And let's see, which one did I want to see? Okay. Well, you can kind of see most people are usually going to buy these somewhere between 52 and 65. You start waiting much longer than that, it gets pretty expensive. And then secondly, you get a lot higher decline rate as well too. Okay. And so if you look at these, you can see here it says, okay, I want to do this plan A, which basically after 90 days of having a long-term care event, it will pay out for up to 2 years at $150 a day. Okay. And then you can either get to where you only get that amount, and then you could, each year they'll give you the choice to buy more, or you can just pay to get it locked in with the inflation adjustment. Okay. And so almost always recommend get the inflation adjustment from the get-go. Okay. So get in a plan that's affordable to you, that already has the inflation built in. So you can kind of see here on that plan A, which is the 2-year benefit, if you were 52, then you'd be looking at, $40 biweekly. Okay. And then, you waited all the way to 65, it's $88.51. Okay. And so it's over double, to wait that, 13 years or so to buy it. And by that time, I imagine it'll be higher than that as well too. Now you can buy longer periods. You buy 3, you can buy a higher benefit and go to 5. So obviously more expensive. So say you're buying this at age 60, it'd be $185 a month per spouse. Okay, but that's actually a really good deal. I mean, it is a really good deal compared to what you can buy on the consumer market. It's probably almost half price. But it's still expensive insurance. You need to evaluate this, make sure it's best for you. Now, this is a standardized kind of policy, so there may be some bells and whistles on some of the private ones that if you've just got the money, you may want, and it may be worth it to you, and you may want to shop it. But as, kind of a ace in the hole, really nice group benefit plan through an organization, this is a really good one. Okay. All right. And premiums are not guaranteed on long-term care. So they try to price them where they won't have to raise them. But over the last 30 years, they have raised premiums multiple times because they promise too much benefit for too little amount of insurance premium. And then people stop dying as much from things. And when they had a stroke, they would just live a long time and be incapacitated. So they totally missed out on their assumptions that they made, thinking that people would die earlier and not need as much care, and that's not what happened. It was like medical technology's actually gotten better. They're keeping people alive for longer. But if you live longer, then there's a higher chance of something happening to take away your activities of daily living, like dementia and, et cetera. And so anyways, there's just a little explanation. So on the dental and vision, we're not going to spend a lot of time on these, but these are, fairly affordable for almost everyone. But again, if you're paying for something you're never going to use, what's the point, right? And so almost everyone is eligible for this, and your kids under 22. And so use your benefits, take care of your teeth. I can't even tell you as a financial advisor how many times I see people, that are retired now taking tons of money out for dental work and stuff. Versus some people never, because they just took care of their teeth. It can be very expensive and painful, and then cosmetically it hurts your self-esteem and you're not as happy. So take care. Take care of your teeth. It is a smart thing to do, and especially when you have a good benefit that you can just sign up for, and it'll pay most of it, if not almost all of it. Okay, so you just got to make sure you're using a dentist that's in network, but I believe most of them are. I mean, dentists are really good at this. It's a little bit harder for the optometrists on the vision side of things, because so many people choose to opt out, even though it is very low cost as well too. But getting your routine vision, knowing when if you had good sight, knowing when you need readers, getting work glasses, etc. For a really low cost can be a good deal. Especially with kids and getting them checked up, because a lot of times we don't think about it, and they don't even think to ask that they can't see. So they need to be getting their checkups as well too. So you've got your 60 days after becoming eligible to sign up, or you hit the qualifying life event. This is pretty standard, whether you're a federal employee or not. Most civilian federal enrollment's going to be sometime early or mid-November to mid-December, and then they're going to put all the information out. You got to make all your decisions, figure out what you're going to do. Okay, so whether you're getting married or divorced, or someone died, or you had a new child, you changed jobs, you're recently hired, a lot of qualifying life events. You have to look up what's specific to you. So now the big stuff, right? This is where we spend a lot of our money, and we cannot control our healthcare industry and the costs. And so making unwise decisions here are really gonna be rough. Are gonna be rough for you, okay? And so let's see here. I just want to make sure. Let's see if we have any questions I can ask, or that ask me. Feel free to put your questions in anytime. I'll try to hit them as we go, or you can save them to the end. Either way. Put them in early, even if I answer them at the end, so then that way we're not waiting and then I end it prematurely, because I think there's no questions as well too. So you can see, obviously there's a lot of money here, $47 billion in healthcare benefits through the FEHB, and you have a lot of choice, more than just about any employee out there in terms of the plans that you have or what so. But I don't know if you've ever seen those economic studies that say, we get, paralysis or analysis paralysis. When there's too many, it's just too tough to choose, instead of just having a few good ones, or maybe there's just 4 of the different ones and they slimmed it down for us, and we just got to find the one type that's the best for us. You just have so many choices, which it's good, but I think it's tough on people. And so when we look at this and who's paying for it, so the government is going to pay for 70% of the total premium of everything, or 72% of the program-wide weighted average of premiums. So some genius actuarial person probably came up with this, or maybe it was just some random government employee in a back office. But that's still pretty generous. I'd say most employer plans are like somewhere between 50 to 90%. And averaging like 60 to 70. So you're still a good bit above average on that. And so you can enroll yourself or self and family. Okay, so it's a little bit simpler, instead of like self and spouse, self and kids, self and family. For a lot of other plans, there's like full dual enrollment. It's not a very common thing. Just want you to be aware that it does exist, but it's generally prohibited. But there are possibilities when you have the opportunity to cover different, and it would actually be more cost efficient for you if you qualify. Sometimes it is good to get a specialist that's in the life insurance. I'm going to show you a tool you can use later on that helps you make some of these decisions more efficiently, especially since there's a lot of permutations. And even though we as financial advisors try to help our clients with these things, this is not what we do. Knowing all the different health plans and all the different states and what your formulary is for the different drugs that you take and what's going on with your kids, it's a whole different can of worms just to stay up on that by itself. And so if you're really getting into a complex, expensive situation, you really don't know what to do, then we need to get kind of outside help from someone that just does this for a living, or a service that we can pay to help us. I might even show you a little bit how you might be able to leverage AI as well too. And so here's your plan types that you can use here. So You've got your fee for service, okay? And so that's generally going to use a PPO, where you're generally going to pay for what happens in network, up to your deductible max, and it can be less expensive because it follows kind of this consumer driven one as well too, which is a little bit more wide open. But we're saying, all right, let's get negotiated prices. The consumers or the patients pay a lot of the initial little upfront stuff, and that way we can control costs a little bit without as many submissions to insurance and this and that. That's kind of the idea behind it. HMO, I think, is what we're normally used to, where it's like a managed organization, usually within a geographic area, either kind of big, local, or regional, and then they again kind of have agreements, and as long as you stay in network, then you're going to do pretty well. If you have to go out of network, then you can start to rack up some costs. The deductible and max out of pocket is higher, and you need permission to do that. Okay, consumer driven health plan, like I had said before, kind of feel like these are very similar to a certain degree in terms of that they're trying to get people to make better decisions with money that they have. So whether you're using kind of like an FSA, a flexible spending account, or an HRA, which is, again, another kind of spending account where the employer puts in the money for you, or an HSA, a health savings account, where you're having money taken out of your paycheck pre-tax that you get to spend tax-free. The thought process behind that is like, hey, if consumers would shop, it would be a more efficient marketplace. I love the idea. Unfortunately, it doesn't tend to work very well because most of these healthcare providers and doctors and what so they will not publish what their rates and costs are, and it's like pulling, needles out of your fingernails to try to get the information to where you can even make a comparison. It's kind of funny. It's like, oh, we can't have universal health care because we want a market-driven system, but we won't make a market-driven system because all these people are making too much money and ripping us off by not making it a transparent marketplace. But anyways, that's what those plans are. Let's keep rustling through here. So just a little bit of extra. I kind of explained them already, but offers the health coverage where the doctors receive a fee for each service, nationwide and international coverage. And as long as you stay in network, you're going to save some money. Okay. And then the HMOs, it's managed care. Again, specific geographic service enrollment. Use the network and get a referral to get outside of that. But you generally want to stay in network. That's a lot of the ones where you hear you shop. Make sure your doctors are all on your plan. That's what they're talking about. Okay. The consumer driven plans. So you get a health fund, like a health savings account. They put money in for you. You get 100% coverage for preventative care because they want you to not escalate to the things that cost a lot more money. And then they'll cover everything that's up in your fund 100%. Once that runs out, then you're going to start doing the regular, depending on what you're in, kind of copay up to your deductible. And then after that, it might get better till your max out of pocket. Okay. That's why they're saying traditional benefits thereafter. Your high deductible plans, you're seeing these a lot more around. It's where, I'd say the most common that I'll see is like where it's like you pay for the first $5,000 and it's $5,000, deductible and max out of pocket. Okay. And then you go over that, they pay 100%. Doesn't matter. But again, you pay for everything. You're going to pay. But if you don't have anything except for preventative, they pay 100% for preventative. Okay, so if all you had were your checkups for preventative, for whatever you need to do that's normal, depending on if you're a guy or girl, etc., then they're going to pay for all that. And you don't have anything else. Then let's say, like for my employees, match into their HSAs, right? And if they've been with me a couple of years, I double match into theirs. So if they didn't have to pay anything for their health stuff because all they needed was their preventative stuff, then they may have put $100 a month in to get $200 a month from me. So they just made $2,400 off their health savings, right? And then you're allowed to invest inside of an HSA, so you can even grow that more if you're building it up. And so you think about a high deductible plan, since it's more probable that you're going to have little things happen, the premiums for those are lower. So if you're younger and you don't have a lot of health stuff, say you're paying $50 bi-weekly, you're only paying, a little over $100 a month, and you don't have any out-of-pocket expenses. You get $2,400 match. Like, you made money off it. Like, that's a good. But the thing that can happen, you could get in a car wreck. You got the whole 5,000. It's gonna wipe out your HSA plus a couple thousand extra bucks. So again, you gotta look at these things and make sure that it makes sense for you. But a lot of these can work very well for you and is worth taking a look at and picking the best thing for you. Okay. Ways to compare plans, and I'll pull a couple of these up for you, so you can see this brochures, and then they have their own plan comparison tool, and they also have and there also is, which one? Yeah. So you can pick which state you're in. I think when I was initially on this, it'll show you the map, so you can pick whatever state you wanted. Say I'm in Texas, it'll give you all the different plans, right? And then you pick, you make it more specific. But there's the fee-for-service plans. If you're like, I want one of these fee-for-service plans, okay? Then you can look at all of them. Then here are all the HMO, HTP, and the consumer-driven, okay? And figure it out. And these PDFs are forever long. They're hard to read, okay? You can also use this, where you can say, hey, I'm in, again, I am in Ohio, so I'm going to use Ohio. Say I'm an active federal employee, get paid bi-weekly, and you could say search, okay? And then it'll bring up all the ones that you're eligible for here. It's a lot though, right? You can pick 3 of them that you think you like the most, and then if you do that, let's just pick 2 just for making it faster. We could say compare plans, and then this makes it a little bit easier than reading all those books in terms of what's it going to cost. It's $113, per pay. And then we can see, what's my annual deductible? None. But the out-of-pocket is $7,500. So more of a copay type plan. Over here is $450, right? And the max out-of-pocket is $6,500. And then you can see how does it work. It's like rules, right? With the copays and different things like that. And so you can compare multiple of them. Another tool you can use is this thing called Consumer's Checkbook. And it goes more in depth about asking you questions about your health, about what you use, who your doctors are, et cetera. And then when you have, if your agency doesn't provide it, because I think a lot of them do pay for it for you already, I think it's only $16. Like, so this is such an important thing. I would do this. I've had a couple clients use it, and they liked it. It helped them. Is it the end all be all of everything if you were to really read all the stuff and it took you like 10 hours? Maybe not perfect like that, but hardly anybody's going to do that. But here you can look up your department or your association and just see. So if you're with the FTC, then it's like, oh yeah, you do it, but you got to do it through your single sign-on or through your intranet or whatever. There's a special page that probably your HR can give you. Okay. If yours is not on here, then you have to pay the $16. Okay. But it's actually a pretty cool thing. And I think on that front page, there is a little video you can watch about how it works and what, so it's not too long or what so. But giving you choices, because so many people do not do a good job electing their health insurance, and it costs them a lot. I think over a 20 or 30 year period, tens to hundreds of thousands of dollars, especially if you would have taken that wasted money and put it somewhere like your HSA or your TSP or, civilian world into your 401k, it would have been a lot of money. Okay. And so we talked about that. That was that Plan Smart Choice was the comparison one. And then that Consumer's Checkbook. Again, it is not OPM or government run. It is a kind of private side gig company, but a lot of even the Euro's agencies do pay for you to use it because they realize that it's so useful for people. Okay, so open season, as we had talked about before, mid-November through mid-December. Make sure that you're getting in there early enough to take your time, evaluate things, or if you have questions or something doesn't work right, you're not pushing up to do it at 9 o'clock at night when the cutoff is at 12 p.m. right? And then you're just like, I need help on something, and nobody's open, or what so. So do it earlier. Earlier is better. than wait until later, just in case something comes up. Let me check the questions just to make sure, see if we got any questions. Again, if you got questions, throw them in. I'll try to answer them anytime as we're going through this. So looking at the ability to save in accounts that are for the healthcare programs, right? And these type of savings accounts are really good. They're some of the best out there because you get to put in and take a tax deduction. They go in pre-tax. If it's in one that can grow, like earn interest, or you're allowed to invest in funds or whatso, then the earnings get to grow tax deferred. And then if you use it for qualified expenses, then you get to take the money out tax free. That's like the best of both worlds. It's like combining pre-tax and Roth together. You get both. So it's pretty good. Now, the downside is you can't save as much, and people tend to spend it faster. So the tax deferral, the tax-free growth, unless you can really start to ramp up on your HSA, isn't as big of a deal just because you're not going to be able to earn a lot of interest to compound over lots of different years. HSA, you absolutely can, but it takes some discipline. We don't see very many people build up bigger HSAs. You should, absolutely you should, but we just don't see it. I don't know if it's because people don't know, or they won't listen to us, or they don't have the discipline to do it, etc. But we just don't see it a lot. So of course, you're probably used to this, using Sam as your example case study thing here for this. So you say, if I'm just going to pay for the $610 I had out of pocket, and I don't use any kind of savings account, and considering these taxes that have to come out, then it's really going to cost like $700 because you have to pay the tax on that money to get $610. If you put it into the FSA, you don't have to pay any taxes on that. So the 610 is 610. So in that example, almost saved them $100 just by using it. Okay. Or, the, 1 to, divided by 6, 16.5%. That's terrific, right? And so you're not going to get that rate of return even in your TSP or investment account generally. So without growing any money and just being smart about your taxes. Now, of course, the higher tax bracket you're in and the more money that you're putting in there that you need to use, the better, the more worth it it is as well too. Okay. And then we can look at the Liberty as well too, dependent care expenses. So you can do FSA for dependent care as well too. And so if you use this, then again, kind of the same type thing, and childcare is expensive, right? And so you can see this $2,000, depending on your taxes, that costs you $25,000 to $3,000 of your gross income. Whereas if you use it through here, then $2,000 is $2,000, right? That's pretty rocking. So again, you just got to think about these things ahead of time, saving them, figure out how you're going to use them. A lot of times, almost once a year, you can figure out how to, this money is just going to come bi-weekly out of here. I'm going to set this payment up to these people automatically through, the Montessori website or whatever, and it just comes out automatically, right? And then it's just like you made a system that took you very long to set up that just works, saves you that $500 to $1,000 in taxes, and that's terrific. And then, this is kind of redundant with what I said in terms of, looking at how the FSA works. Reimburses you on healthcare, dependent care costs. A lot of times there are debit cards and stuff you can use directly if it's eligible to, and you don't pay any taxes on those. It's a good benefit. And so you can use it on the health, you can use it on the dental or the vision, etc. And again, other things you just think about: eyeglasses, contact lenses and supplies, orthodontics, co-pays, even over-the-counter type stuff a lot of times qualifies for now. It didn't used to, but does now. And then the dependent care, like we had talked about, you just got to make sure you follow the rules. Adult daycare counts as well too. So if you're taking care of another dependent that needs someone to stay at home with them, whether they're like special needs or maybe you're taking care of one of your parents that is actually a dependent now and they need someone to stay with them, generally not someone, you or your spouse. You're not going to be able to pay yourselves usually on these. Okay, and then you've got three kinds of different accounts. So this Lex HCFSA is for when you pair it with an HSA. It's kind of unique because most people cannot do an FSA with an HSA, but this does allow you to pair it. But you start getting into all these stacking and what, so you really got to have your P's and Q's in order to do it well. And so dependent care, the HSFSA and the Lex HCFSA, you cannot pay premiums for insurance for it. You cannot do like elective cosmetic type procedures. And then over-the-counter drugs, I think this might be changed because this was an updated presentation from a while back. And then dependent care, you're not going to spend it on health care. You can't give money to your other dependents that are taking care of people, paying for education or tuition or transportation. You got to make sure that you're following the rules. Okay, so that's kind of what that's talking about. Follow the step-by-step rules. Make sure you're doing right. But after you know them, then you're going to get in a groove. And then it's more about how much do I put into there. Okay, and so when you're looking at this stuff, especially with FSAs, you got to be careful that you don't overfund them, because it used to be a lot harder core, like use it or lose it, like 100% hardcore. Now they'll give you a little bit of flexibility. You usually get one or the other thing. You either get a grace period at the end of the year, or there's a little bit of rollover that you can do. So then that way, if you're trying to calculate it right on, and then you end up with a little bit of extra, you can roll it over. Okay, but you do want to do some calculations to really figure out how much to put in there. Beyond just budgeting, can you afford it? It's just like, will I spend it? Okay, and so minimum $250 per participant, maximum $2,500, and then dependent care goes up to $5,000. And so there, you can roll in line. Talking a little bit. I'm going to skip this stuff. Some of these things have paperless reimbursement. Actually, I'll come back to this. We were talking about it, and I'd like to hit it first. Hang on. Spread this out too far. So minimize risk of forfeiture. So if you're going to get the grace period, they're going to give you until March 15th. Okay, so you got to spend that extra money in there. The other thing is that you can roll over $610 to the next plan year. But again, you're not going to get both. Okay, so if you got a grace period, don't expect to carry over. Make sure you know what the rules are and don't mess it up, right? And then if you kind of planned right, you're going to hit close to what you needed to spend. And there's usually some things that we could pay for, or or more bills medically than what we thought. It's just how the healthcare works these days. Then you're usually not going to end up with a bunch extra. But do check it out, especially if you're doing it and you enjoy the tax preferences. Some people get carried away and put too much in them. So the one thing that I kind of skipped up there was the automatic reimbursement. Some of the plans have the ability, when you're paying things at a medical facility or whatever the case, that it goes through their system and they automatically reimburse you back, which is nice if you're with one of those providers, plans, etc. So save the money. Save the money on these things that are expensive, that you need. You need to take care of yourself because your health is an asset. And later on, I can tell you from dealing with tons of our clients that have retired, unfortunately, even all the way through to died, the ones that took care of themselves had so much benefit from how much less their health cost them, and then their quality of life on top of that. Okay, so once you save that money, talking about retirement stuff. And so, this is really important. And a lot of people, they know they're in it, hopefully, right? But they're not necessarily optimizing or understanding how it works. And sometimes you don't have to do much, but except for those inflection points when you change jobs or you're thinking about this opportunity to follow this other opportunity, not just what's the salary and who is the employer. It's like, what's the salary plus all the benefits plus the retirement? You got to add it all together. And I've seen a lot of people make the mistake just thinking that a little bit higher civilian or private salary is just better, that when they added all their pension or whatever, on top of it, that it was actually pretty even, or maybe even a little bit better on the public side. So the FERS, the Federal Employee Retirement System, provides a retirement benefit when you retire based on a formula. If you become disabled, provides a disability benefit based on your years of service and average salary, and that gets combined if you can qualify and get Social Security disability benefit up until it would flip over to a retirement benefit, and provide survivor benefits for your spouse, significant other. Okay, so it's a 3-part retirement system, and what we mean by this is that you have FERS, okay, that is your pension, okay, and we call it defined benefit because it's defined by the benefit you get in the end, not how much money it goes into or how much they grow it into. It's a formula, okay? And then you combine what you get from FERS with Social Security. They work together. So when you work for the Fed, you are going to pay into both, you and the employer. And then you have the optional ability to save in your retirement plan through work. So it's funny how most people will know the private system better than the federal system, or if they're a teacher or something in the state system. But your TSP is just like your 401k. So most people at a company, they have their Social Security and they have 401k. That's it. Okay, there can be some exceptions, but in general, that's it. It's like a 2-part retirement system. So for you, it's a 3-part. You get the pension, Social Security, and your TSP, which is like your 401k. And then your eligibility is going to be based on your age and years of service to be able to fully retire. And so that means is to be able to get a benefit and not have to wait longer or work longer, then you got to meet one of these 3 things, okay? 30 years of service, regardless of how old you are, be 60 with 20 years or 62 with 5 years. And then generally unreduced benefits, so not take a penalty, be over 65, okay? But they have been changing that. You've seen that a lot with the pensions now. They're starting to move up to 67, kind of how Social Security did as well too, since people are living longer. And then your thrift savings plan, as we had talked about before, that's your 401k. You're able to do it pre-tax, so you can save and take a deduction and then get tax deferred and then take it out in the future and pay taxes, or you can do it Roth. So pay the taxes right now, let it grow tax deferred, and then get to take it out tax free. So the way to think about this is if you think you're in a lower tax bracket now, let's say you enlisted in the military and you're 20 years old and you're saving in, you're probably not paying a lot of taxes. So you're going to want to save Roth, for sure. You're going to want to save Roth. And then in the future, hopefully you did your service, you got out, you got your pension in your backpack, and you go out in the civilian world, do 20 more years. That money grows a lot, and you're going to get, the growth in it is like 8 times what the principal was, and you get to keep all that money tax-free. That is a tremendous benefit. Now, if you're 55 and you're going to retire at 62 and you're kind of at your peak earning years, and after you retire, your income's going to go down, that pre-tax might be better because you might be saving like 28%, and then when you retire, you're paying like 18. So that's great, right? You really got to think about it though, and it may change over time with either where you are in your life, what the tax brackets are, what the politicians do, when you want to retire, etc. That's again where we come into play, helping people model out everything, retirement planning, like permutation wise, all the different ways you could do things. So a lot of agencies, automatic 1% contribution and matching 4, so up to 5. So most people need to be putting in at least 5%. I would tell you that's great to be putting in to get your matching. That's like not leaving money on the table. But most people need to be saving like 10 to 15%. So I know it's tougher at lots of different points in your life, but you should be trying to get to 15% into there, and then let the agency heads and the government argue about how much they're going to match. But you save what you need to save, regardless of what they're going to match and put in for you. Okay. And then the different funds you have, and we'll talk about these a little bit more. There are loans and hardship withdrawals permitted, but I tell people you should think about these pots of money as just like untouchable, because their real superpower is the interest to grow and the interest and the interest and the interest and the interest. So you want it to compound for lots of years in a row. And that's where you get that exponential growth. If you rob it early, where it would have hit the elbow, you'll just keep going sideways. That's why when most people, when they're saving for retirement, they would hit that elbow and go up. But what happens is once they start to save real good, that's about when they retire, and then it goes sideways and maybe down a little bit. Okay. And so if you're taking out premature withdrawals, you're not going to save up the money you need for retirement. Okay. And then this is a defined contribution plan. So you could just take it all out. You could roll it over to an IRA. You could say, pay me $1,000 a month indefinitely. You could annuitize it, give it to an insurance company and say, based on how old I am and what interest rates are, pay me a guaranteed, almost like a pension for the rest of my life. Or you could split it and do a combination. So it's very flexible. It's very portable. If you change jobs, you can roll it over to your new 401k and IRA, an individual retirement account, whatever you want to do. Okay. And so we talked about this before about how it's split between these three things, and you put them all together to see what you're going to get. And I'm going to say, should I be leaving money in my TSP once I retire? You absolutely can. As I mentioned, you can leave it there. You can roll it over to an individual retirement account. Some people will even convert it into a Roth, or maybe a part of it. So you can do a part into an IRA, a part into a Roth IRA. It depends on your tax planning there. If you have a new job and you're not retired, you can roll it into the new one. You really just got to look at what are the benefits that you get from the TSP and how you like the investment options into there compared to the benefits, the investment options, and the costs of what's in the IRA or the 401k. Okay. So that's very individualized. Personally, I think the TSP is a very solidly built, very low cost, it is a lean, mean investment machine, but it is just missing so many components in terms of, different eggs in different baskets, from being able to choose between value and growth and, getting small value, small growth instead of just a small index fund, and no mid caps. And on the international, it's mainly only developed. So you can't get any exposure to like South and Central America and Asia and some of the other potentially higher growth areas. And then fixed income, you either only get really high quality corporate bonds or government bonds, like US government bonds. And there are just so many other types of bonds and different things else out there that you can invest in that you can get in an IRA. You got to be careful because not all of them are good, and some of them are ripoffs or charge you too much. So it is very much, when you go the IRA route, you get a lot more freedom. There's a lot of awesome possibility. It's also buyer beware. Okay. All right. And then let's keep moving on. This is just talking again about retirement eligibility of when you can retire. Okay. Generally, we don't want people to get any reduced benefit. Okay. And so you want to hit the ages that you need to. If you are changing mid-career wise, then you're generally you have that benefit there that you're going to claim when you hit it later on. But you got to do the calculations. I've had some people that taking the reduced benefit based on their circumstance actually left them more ahead than waiting like 3 or 4 more years when their salary wasn't going to go up anymore. Okay. Some people, if it's really early, you can get a return of premiums to a certain degree on investing, but there's very few and far between where that works out the greatest. So in terms of where the money's coming from, the employer's putting most of it into there, 11%, and then depending on your agency hire date, you're putting in almost 1 to 4.5%, and then there are a couple different things that can bump it a little, like sick and vacation time popped into there. So make sure, regardless, that you have Social Security and a pension, that you're contributing to your TSP. I'm running out of time, so I'm going to scoot down here. And here's the investment options. Like I said, the G fund is for government bonds. F fund is for the corporate high quality bonds. The C fund is large companies in the United States, much like the S&P 500. The S fund is for small caps, small companies. International is the I fund, and the L funds let you pick like the target date. Like I'm going to retire in 2055 or 2045. And then they kind of mix the things together for you and adjust it automatically over time. Okay. Civil service, I'm going to skip this. I apologize. I didn't manage my time well. And then the military pension, if you're old school and you got the old one, it's 20 years or nothing. I served 8 years. I got a big fat 0 on this. It really sucked. I was a big proponent for them changing this for a long time. There's so many people that have served honorably and awesomely, and we're not able to get their full 20 years, and they got nothing. And there was nobody there to tell them to put into TSP or anything. And so it's really nothing besides if you use your GI Bill. I appreciate it. All of you saying thanks for your service and what's so. That's your benefit from that. Now you got the blended retirement system. It's a whole lot better. It's a less percentage, so instead of the 2.5, it went down to 2%, but then there's a match into the TSP, and then there is the ability to have a smaller benefit or get contributions back, etc., on the pension part of it, if you're not going to, do a lot of years of service or retire, at 55 to 65 or whatever the case from the system. So it's much better that, our service members, even if they're not going to, serve 10 to 20 plus years, are going to get something out of their retirement. But there's still some planning that needs to get in here. You need to get in the TSP as well. They're not going to take care automatically about your retirement. And so I did a couple case studies. We're going to run a little bit over. If you got to go, I understand. We'll send you the replay and you can hit the end at the end. But I love the case studies because they help you visualize a little bit better and think about the permutations that can happen. But if you ever need help or have questions, reach out to us. We do a lot of modeling this for people so that they can visualize it better with graphs for their own personal situations. But let's look at these real fast. So this is a FERS career starter. So what I mean by this is that they, at 25, maybe after they're done waiting tables or whatever they did, took a federal service job at 25 with a $45,000 salary, worked for 35 years, had 3.5% on average salary growth, and so retired at age 60, with about a salary of $150,000. We look at this, 35 years, 1%, high 3 average year salary. Their pension came out to $49,000 and some change. Their Social Security at about $32,000. That's in dollars. It might actually be higher in future dollars. And then total retirement income will be about $81,000. So just with the pension and Social Security, that's pretty solid in terms of how they shook out at the end. It's still a big pay cut now, just relying on the minimum of what you're mandatorily opted into without doing any of the optional. And so this kind of takes that same case and just says, all right, what if this person put in to their TSP for 6%, put in 6%, made 6%, and so at the end of that, it would have been about $581,000. If they took out 5% per year, they'd make almost an extra $30,000 bucks. So now they're at like $110,000 a year. Okay, and all of these have pretty good cost of living adjustment, or these two do. And then your investment portfolios, it depends on how you invest it and take care of it, but tend to be resilient to inflation at all. This would be very resilient. There is a cut, but again, if you're saving money into this, your health insurance expenses go down with Medicare, et cetera. That's very doable for most people, especially if they paid off most of their stuff. So you can see where, it's 7%, not 6%, but where saving in your TSP, even though you have a pension, is a very good idea. These are like saying, what if it's a mid-career transition to FERS? And so they worked in the private sector from 24 to 50, starting at 25,000 when they were young. So again, a little bit lower, and then they worked their way up 3.5 raises. So before they left, maybe they didn't really save in their 401k until they were 35 to 40 and only saved those last 10 years. Very common thing. I would say they accumulated about 110,000 in their 401k, came in, got a good federal job for them that they were happy with for $50,000, worked it for 15 years until they were 65, contributed 6% with a 6% return to their TSP. So then you can see they're going to end up with almost $12,000 a year from their FERS, about $20,000 a year from their Social Security, and then about $18,000 a year from what they would draw out of their investment account. So about $50,000 a year. So now maybe their salary went up to 65,000, somewhere around there. And when they retire, they're retiring back at 50. But that's pretty good, right? You don't have to work anymore, and you can live off of that. Okay, so but again, you can save more, you can save less, you can save Roth to make it tax-free, you can pay off your house faster. There's so many ways to do this. I'm just trying to help you understand some of these different permutations of what can happen. So we got someone that's enlisted at 18, they served 11 years in the military, the $40,000 salary, contributed 5% to their TSP, earned 6%, transitioned to a 36-year career in civilian world, earning $55,000 and then adjusting up, get their military pension. They save up almost $600,000 in today's dollars. They have their Social Security benefit, so they retire with about $70,000 a year. So again, these aren't perfect because there's just so many variables that we could change inside of there. So there's a lot of room to optimize in here. If someone would have saved more, or saved Roth, maybe there was the opportunity to take some of this money back and put it into here, and it would have made it grow to 700 and something thousand, and it made more than this. So there are lots of different ways that you can do it, but this just kind of gives you an idea of thinking about where does the money come from to be able to not work anymore but live. Okay, and so that's pretty much it. I ran over a little bit. I apologize on the time. I hope that helped you. I hope that saves you some money on some of your benefits, or understand them better so that you can use them more wisely, understand the retirement a little bit more and how to put it together. We do free consultations if you're interested in digging more into your own individual circumstance. And so if we can help you, in terms of just with that one-off thing for free. If we can help you on an ongoing basis and provide value to you, we would be happy to do that as well. So, click the link from when we send you the follow-up email if you're interested in that. Otherwise, thanks for joining us. Let us know if there's anything we can do in the future. Join us next week. We're going to be going over how to use AI for help making better financial decisions and some of the different actual use cases. I'm going to dig more into just mainly use cases for that, and how to put your queries in and how to use information for it to help you be more savvy. So have a wonderful rest of the day. Thanks for joining in with us today, and we'll see you